Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. I hope you're all having a very good day. Stocks, currencies have finally gone the way of our view of late, which is stocks are highly overvalued here because there's most certainly a continuing decline in US earnings about to happen. It's already in play, but an even bigger decline in earnings in the US is going to happen throughout this year and perhaps well into next year, as the economic slowdown there has no magical base from which it will bounce. And I think people greatly underestimate the potential for further economic slowing as the Federal Reserve continues to hike interest rates. And I think you can still use the word hike interest rates aggressively, because it will be 25 points at every meeting until inflation is defeated. And this means, it may mean that you have to get a soft jobs environment, but you're not going to get that because there are 2.6 million fewer workers in the US economy at this point. That's why all the layoffs aren't really showing up in the unemployment figures, because there's still a demand for workers, but the workers aren't there. Therefore, the economy is running at a much slower level than people think because of the low unemployment number. So all the other economic data, as I've said many times before, remains very weak in the US. We did see the services PMI, ISM PMI, bounce back into expansion territory after being in contraction. And that's good to see. However, I'm not sure how long that will last. And also the prices component of that ISM data last week was still extremely strong, way up there in the 60s. And I think that suggests that inflationary pressures from services going through the year in the United States are going to remain very strong. And that's one of the features of the economy that the Federal Reserve has been highlighting. So it certainly is looking like inflation is far from being dealt with significantly. It's certainly, people got very excited that inflation is lower, but it's still at extreme levels. And people tend to fall into this era of assessing current data compared to recent data instead of assessing current data in the big picture sense of what is normal to that particular economy that you're looking at. And when we look at inflation in the United States at this point, it's still truly diabolical. Anything above 4% is deeply concerning. Above 5% is a crisis. Above 6% is just exponential problems ahead. Because inflation eats away at the foundations of the economy in a long-term sense, the longer it is in play. So that's why the Federal Reserve has been so keen to jump all over it with these late to the party aggressive interest rate hikes. Now, it slowed to 25 points at the last meeting, so there was an interest rate hike and a very clear warning from the Fed that there's going to be at least another couple of hikes, and it could be more. But the market found that reasons to celebrate, because the market assumed that the Fed is wrong. On this occasion, the Fed is probably right, so therefore there's a severe mispricing between the market and the economic reality that lay ahead of us. Because remember, the level of stock prices isn't just about interest rates. But interest rates are going to further damage the US economy on top of the damage being done by the actual inflation. And we're going to see an economy that is in, almost not free fall, but is certainly slowing quickly as well. Speaking of slowing quickly, Eurozone retail sales yesterday really fell sharply off a cliff. And that's in tune with what we've been seeing in US and Australian data. So if you like, it's a Western economy consumer retrenchment period that we're in. And I expect that consumer retrenchment psychology to only get deeper. So that's why still warning of a possible recession in Europe this year. Still think a recession is on the cards for the United States as well as in Australia. So still cautioning about being overly enthusiastic, as a lot of people have been lately, on their stock market holdings. The price action had been very good. I was very bullish stock market based on price action, but it was stretching from the fundamentals. That stretch has reached its zenith, and now we're going to see equity prices and the economy, the gap, begin to narrow. And if the economy is still in decline as the Fed hikes, that means equity markets have a significant fall ahead of them. On the day equity markets want to bounce, it is, we've had 2-3 days of sharp declines as we have in euro and Australian dollar, and all these markets are looking to bounce now. But yesterday in New York, the buyers were back, but they couldn't keep the market up for very long, and soon the sellers were back trouncing them. So there is real selling in the market now from major players, which we hadn't seen all through January, which is why the market went so high. It is a worry that perhaps a lot of the world's biggest funds were actually waiting to see how high the market could go before they begin to offload some stock. That remains to be seen. It's a slightly left field scenario, but it could come into play. I do think the outlook for equity markets is at best sideways, but more probably very much to the downside. The outlook for the US dollar long term is a much lower currency, but short to even medium term, even over the next 6 to 18 months, it could be a firm currency again, particularly if there are safe haven flows, should there be a flare up in Ukraine, as I have been warning of since the end of last year. And the Ukrainian government came out yesterday and warned itself officially that Russia is getting ready for another major push. I've been telling you that for several months, for a couple of months at least, and I think that is unfortunately going to happen. So there could be another shock to food and energy supplies and the world economy over the next month or two coming out of that conflict yet again. Probably not as severe, nowhere near as severe as we hope as the first round, but there could be another shock, which markets have kind of tried to look away from, not take on board. And this whole sort of false narrative about how Ukraine was winning the war, etc., that's all obviously now patently, clearly, self-obviously not so true. And the areas that Russia is seizing, Russia will probably still be keeping long term. But unfortunately, in the near term, it does mean there could be more pain for the people of Ukraine, the military of both sides, and shocks to the world economy. Let's hope not, but be aware that that is a risk to your portfolio at this stage. In Australia, we've had weak retail sales recently, and today we've had data suggesting that the trade surplus may have peaked, and I believe it has peaked. It's going to be a choppy period of rolling over, but I think Australia's sort of best ever trade surpluses are now behind us. Trade surplus is down to about 12.5, something like that, in the latest data. So it's dropped about 10% from the previous number, and I think the trend will remain to the downside there. We will, or probably by the time you watch this, we will have got a result from the RBA. I can speak as if it's already happened because we all know what it will be. The RBA has raised rates by 25 points. What I think could concern the market a lot is I expect the rhetoric or the accompanying comments to be very hawkish indeed. That, because remember, the RBA slowed from 50 to 25 points, only to see inflation accelerate through the roof to 7.8% after they did that. So they definitely need to keep hiking by 25 points. It's possible in their comments, they might even say we might even have to increase by larger amounts if inflation doesn't come down. I'm sure that's what they're thinking. Whether they'll say that or not remains to be seen. But I do think the Australian dollar is exposed to the interest rate hike because it will be still not narrowing the gap, if you like, to the US. And the Australian dollar had already had that tremendous run up this year, which also now looks to be tired. Both the Australian dollar and the euro look like they're trying very hard to rally on the day, and we could see some immediate volatility in the currency around the RBA decision. But I do think overall it will end up being a rally to sell, but I'm not sure how high that rally will be. The US dollar itself, as I said, It's in the process of bouncing back from the sell-off of the last few months, and that bounce back phase has further to run. There's going to be a pullback here perhaps in the value of the US dollar for a day or two, but the risk is very much in the near term to the upside for the US dollar. For the Australian stock market, the RBA's rhetoric or comments that we see after this rate hike will probably be concerning enough to cap any potential rally in equities here domestically, particularly in light of the US market itself having clearly shown signs of rolling over, perhaps for the rest of the year. Clifford Bennett, Chief Economist, ACY Securities, thank you very much.